Hi everyone. I've been asked to talk about mortgages, mortgage-backed securities, securitization, and bricolage. So I'll do that with the drawing your attention to some of the slides that I've used in the past. So securitization. In simple terms, this is banks originating assets and then selling them on. Okay, so you might well be getting confused by the securitization term and saying, well, how does it relate back to security? Sometimes in English, words are appropriated and used in different ways, and this happens quite a lot in social science. So you need to be au fait with the terminology. Okay, and securitization relates to the originate to distribute banking model, is that we'll originate the loan, but we'll distribute it by selling it off, and therefore it doesn't have an impact upon our balance sheets. The key idea is that we raise funds from outside investors through a bond issue, which releases liquidity and reduces risk. So in other words, that we are borrowing money in order to be able to originate assets and then sell them on to somebody else. And then the money comes back and it churns and it goes round and round and round and round. Securitization specifically, therefore, is the issuances of marketable securities, derivatives, mortgage-backed securities that behave just like a bond, backed by cash flows from those assets. So in the case of mortgages, is that we package up a lot of mortgage-backed securities and securitize them by selling them onto the open market, and then they're backed up by the cash flows that are derived from the people who've taken out the mortgage. Yeah, so when you buy a mortgage, is that you pay a fee every month back to the bank, which is part capital repayment and part interest repayment. And at the beginning of the mortgage, is that you're paying more interest than you are paying off the capital. Okay, so it's the payment by mortgage holders that actually makes the securities work. And there are a number of different parties, which is set out on the screen there. And I don't profess to go through those because there's no need to do it. You can read those at your own leisure. And then there's an additional party here, which is also the credit rating agency. And the credit rating agency has rated the mortgage-backed securities, and they rated them very highly. In most cases, they rated them at AA and above, AAA in many cases, because they perceive the ways that they perceive that the fact that the mortgage-backed security has been made secure, primarily because of the fact that what you're doing is that you're packaging together lots of different mortgages from all over the place. And the statistical likelihood of each one of those mortgages failing at any one particular point in time is low. So if you've got mortgages all over the country and you package them together in one mortgage-backed security, is that some of the mortgages within there might fail, i.e. somebody will stop paying 1 month but might pay another month. But by and large, is that in aggregate, the majority of people will pay on a monthly basis, and therefore the security will work. Okay, so not surprisingly, you get huge growth, therefore, in the securitization of assets, specifically linked to the growth of the mortgage market. Okay, so there is huge interest in originating mortgages, individual mortgages, packaging those individual mortgages up into mortgage-backed securities, and securitizing them by selling them on to an additional to investors. Now, in securitizing it, it makes a in fact, I'll come on to that. Just to show you the growth of securitization from 1996 is that you're looking at 685 billion in the US, up to 3 trillion by 2006, and the growth is comparable across the world, although the numbers are not quite the same. And what's important to note here is that securitized mortgages grow significantly, but what happens after that is also part of the issue here, and that's the bricolage. In that bricolage is the utilization of existing tools in a way that is appropriate to the conjuncture, to what's happening in the time and the space. And I'm reluctant to use the word innovative, because innovative always has the connotation of it being beneficial. And that might not always be the case, as Beck has demonstrated in his writings, is that innovations bring positives and negatives. There's no universal positive something, even though the notion of innovation is, and entrepreneurs for that matter as well, has always got this sort of like the positive connotations. You know, innovation means something good, but it doesn't have to. Okay, and I'll talk about that in a minute. So the benefits to securitization is it claims that resolves liquidity problems for banks and allows greater lending. How does it do that? Well, if you're selling the mortgages off as a security, is that you're being paid for them, which means that you get influxes of liquidity. Reduces capital requirements because of the fact that there is no impact on your own balance sheet in terms of your capital requirement that you have, or it might be negligible. You might use a certain amount of your own capital in order to be able to originate the mortgages, but by and large, people are just borrowing money in order to be able to originate mortgages. So it has and then your money comes back into it again, which you can replenish your capital stock. Okay, so you've got lots of cash flow is very high, and the balance sheet doesn't take much of a hit because there's no churn on the balance sheet. Okay, so therefore it improves your balance sheet and it boosts return ratios. Okay, so return on equity and so on and so forth all go up as a consequence of this. And it takes the balance sheet risk away, because what the banks did is that they will set up an independent but fully owned company, which is technically off the balance sheet. So it's an independent company, but it's owned by the bank, and they handle the origination and all of the transactions that relate to it. So effectively, what's happened is that the balance sheet risk has been removed because it's gone somewhere else. So it's a way of financializing the bank's accounts to, in effect, make them less transparent, but also to present them in a way that looks more preferable, more positive. And it means that the narratives that the banks can use are more or they're overtly focused on the positive elements of it, as they can say that, you know, we're making all of this money and there's no balance sheet risk. Look, but we're not drawing attention to the special purpose vehicles over there that's handling all the transactions. So securitization also can be claimed to say that it benefits other people, benefits the investors as they're investing in low risk notes and making a return on it. Particularly when you're looking at the good quality mortgages, but you're making a return on the investments, but you haven't got the hassle of having to originate mortgages. You're just buying somebody else's, in other words. They've done all the hard work for you. The obligers, as it says before on here, is that they're the original loan customers. They have the obligation to pay. They get access to cheaper finance and mortgages because we're making mortgages more available, because there's a demand for mortgages. And the economy benefits as well because we're extending liquidity, improving investment, is that there's a widening and a deepening of finance. And finance, of course, as we have learnt, is mainly theorized as being this transference from savers to investors. And that is a good thing, you know, is the investment into the economy. Is that banks act as intermediaries, finance is the growth engine of the economy. So this is just accelerating that in terms of the type of investment that's taking place and what's known as financial deepening. More people can be involved in it as well. And the credit rating agencies, because they're engaged in it, they're maintaining standards as well. So there is therefore is that the risk is being effectively managed. Now let's take the story one step forward and develop the bricolage. Is that the story starts with a mortgage, and then many mortgages that are packaged up together, the securitization of that mortgage-backed security, which is effectively selling it onto the open market. Well, if you can take a mortgage and package them up into mortgage-backed securities, i.e. many mortgages, why not package many mortgage-backed securities into a new derivative, which is known as a collateralized debt obligation, a CDO, okay? And as I explained before, these things are set up like a champagne tower, okay? It's just all, think of it on this picture here, is that every champagne glass is a mortgage-backed security. Now, within each mortgage-backed security, there's lots and lots of mortgages. And you just structure them in this particular way, so that when people start to pay their interest payments on their mortgages, is the money all comes in to the top of the CDO. Okay, so the money comes in through a narrow funnel, if you like, and then it cascades out. Is that once this glass at the top gets full, is that the champagne will start to go down to the next one down. Instead of champagne, just think about money. As the money comes in, it filters its way through the CDO, but the top glasses get paid first, and then the next ones below, and then the ones below that. So this means that we can effectively slice and dice or tranche the CDO, so that people, when they buy the CDO, is that they're buying a part of it, not in its entirety. They're buying a part of it which is commensurate to the level of risk that they want to buy. So the top ones, the top tranche, which is the premium tranche, has got the lowest level of risk because they fill up first. And as a consequence of that, you get the lower rates of interest on those. So there's lower yields on those because they're more secure. And as you go down, then the yields, the expected yields, they increase, because those who are buying a tranche at, say, 8%, is that they might not get paid every month. But when they do get paid, they'll get paid big. Okay? So you split the CDO up into a series of tranches that appeals to various sections of the market. Now, you can see now how we're using, or how the bricolage comes into it, is that you start with a mortgage, mortgage-backed securities, package mortgages, package mortgage-backed securities, CDO, tranching CDOs in order to be able to sell to the market. And then on to that is that you can secure, or you can make secure, reduce the risk of the top tranche by adding an insurance contract to it, which is known as a CDS, credit default swap. So adding together various financial instruments in ways that are appropriate to the conjuncture in order to be able to maximize or make profits, to make money. Because the banks that are doing this, remember, are all private sector banks. They're all profit-making banks, and they're all shareholder-driven banks. And there is a requirement to deliver shareholder value through either share prices, dividends, and so on and so forth. So there's quite a lot of pressure that's being put onto junior traders and investors in order to be able to sell mortgages, mortgage-backed securities, or latterly CDOs, okay, and collateralized debt obligations. Now, again, if you can package mortgage-backed securities into a CDO. Now, if you hold a lot of the top premium tranche CDOs with your credit default swaps that are in it, the insurance contracts, both of which are paying a premium into an interest rate payment, you can package those up as well. And that's what effectively they did. So you start with an initial mortgage, you go into mortgage-backed securities, CDOs with CDSs, which are now packaged together in what's known as synthetic CDOs. So it's a bit like a domino, domino trail, is that you push it, it has consequences for the next domino. But imagine that the dominoes get bigger and the consequences get wider, because all of these assets, which are being, these securities that have been traded extensively throughout the market, are reliant upon somebody paying their mortgage or sufficient people paying their mortgage. Now, once the mortgages are being, or the whole of the security asset, the assets are being based on mortgages that are being sold to subprime clients, mortgage holders, is that the risk goes up. So you have long chains of debt from mortgages, mortgage-backed securities, CDOs, CDSs, synthetic CDOs, that are all dependent upon people that are at this end of the market, subprime, paying their mortgages. And once they fail, the domino effect kicks in. But because each mortgage is being used more than once, and it's in a chain of debt, is that the dominoes don't just fall linearly, they fall outwards as well. And they get bigger and bigger and bigger. And that's where the risk kicks in, and that's why a lot of these assets failed. Okay. So latterly, in our face-to-face sessions, we talked about the current conjuncture. And what we're starting to see is assets being collateralized again, but in this time it's corporate loans, corporate bonds. And what we did is that we drew attention to the bricolage, which is as a consequence of the current conjuncture, low money, cheap money, lots of liquidity, corporations struggling to make profits because of COVID and so on and so forth. So they are taking out financing in order to shore up the company, but also to return to shareholders, which is one of the reasons why stock prices are still quite so high. So there's an indication of the current bricolage that's apparent today. And then we also related that back to Minsky's model as to say, well, is this a bubble? Can we see examples of Ponzi financing, and where you've got corporations that are investing in the debt of other corporations, is that it might well be that we've now got long chains of debt, but this time in the corporate environment, which is pumping up a bubble in corporate debt. Now, I'm not suggesting for 1 minute that should this fail is that we're likely to see crisis of the like of the global financial crisis. That would not be likely. But what we are seeing is that there is increasing levels of debt repayments and debt risk that is being put onto corporations. And if a particular corporation is buying the debt of other corporations, then that transfers the risk. Okay. So there is a possibility, and I can only say it is a possibility because I don't know, is that you might see failure of corporate debt and then failure of banks and other institutions that have invested in that corporate debt. Failure is probably too strong a word, but you might see the increase in non-performing loans and bad debt appearing on balance sheets of companies and so on and so forth, which will put more pressure on the individual companies. And this market is being accelerated by additional liquidity that's been provided by central banks. So I think that what's interesting is that the bricolage of the global financial crisis is almost being replicated by the bricolage of current traders. And you might say, well, don't we learn anything about this? Why is this carrying on in the way that it is doing? Does it look similar to what occurred before the global financial crisis? Well, the answer to that one is that you've got a whole new generation of trader. Is the investment bankers at the global financial crisis was 16 years ago now. They've all moved on to different jobs, higher up, more senior, and so on and so forth, to be replicated by a younger group of investment bankers and traders that are determined not to make the same mistakes, but bricolage will determine that we've got the tools, but we'll need to make them secure. So we'll look at variance at risk calculations, and we'll look at making sure that we don't leverage quite so highly, and so on and so forth. But there is a belief there's the new ones that come into it, the new traders, the junior traders, the more innovative, to use it in its widest possible terms, believe that, you know, there is a sense that they can do better, and they can learn from the past by looking at their calculations and so on and so forth. So one of the things we do know about financial crisis is that they repeat each other on a periodic basis. Now, according to Minsky, that's because they're endemic. It's built into capitalism. Capitalism is not stable. It's inherently unstable. And crisis is a natural part of capitalistic processes. Okay. Well, I hope that's explained bricolage, securitization, mortgages, mortgage-backed securities, CDOs, CDSs, and drawn it into the current conjuncture. If you've still got questions about any of this, then I suggest that you write to me directly, email me directly, and I will try my level best to help you out. Okay? See you later.